Hi everybody, welcome to the Finance This Property That podcast. My name is Dion Fernandez and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Hey everybody, welcome to this episode of Finance This Property That. Another wonderful guest today. We've got Troy from Willow Wealth Partners. Today we're going to be talking to you about a couple of pain points that my ideal client looks at. My ideal clients, obviously, I deal with time poor industry professionals like lawyers, solicitors, medical professionals, self-employed clients, and also people that are investors. Sometimes they're all three, which kind of helps. There are a couple of pain points that I really want to drill down to, and the reason why I've got someone like Troy down on here as well, he's part of my bigger support network that deals with specific type of advice. Now, what I want to run through today and what I want to teach people today is around planning and diversifying using different methods of lending. What I mean by that is, you got your traditional borrow in your name. There's three different ways you can lend: borrow in your name, borrow in a company or trust, or borrow in a self-managed super fund. Now, what Troy's specialty is as being a financial planner will be around that self-managed super fund. Should you, shouldn't you? Now, I want to start off by saying this: the information you receive today, and I normally do this at the end, but I want to do it right at the beginning, is very general in nature. It does not take into consideration your personal circumstances. Troy is not giving you advice, and neither am I. So if you want the advice, please come and chat to us separately, and we can talk about your current situation and how we can help. But without further ado, Troy, welcome from Willow Wealth Partners. Thank you for coming.
Thanks for the invite. For our side of things, we deal with self-managed super funds all day, every day. They're a big topical point for people, especially your demographic being self-employed individuals, high-income earners. So we do get a lot of inquiries around self-managed super funds and, what are they? How do I set one up?
Before we go into that, I want to know a little bit about you, right?
Yep.
How Willow Wealth had started, because I know I've seen your growth, and also you're coming from the fact that you're also a small business owner as well.
Yep, correct.
So this is a great segue to how do we help. So tell us a little about you and personally, professionally, and how long Willow Wealth's been going and why?
Yeah, perfect. So I started my advice journey actually almost becoming an accountant. So in university, I started going down that accounting route. Now, lecturer just said, let's do a double major. It's the same cost. Got my first job in advice and absolutely loved it. And that's coming up to 10 years ago now. About 2 years ago, we decided to leave that employed land, like a lot of small business owners have that epiphany to step out on their own. So for us, it was really, it's the perfect timing. It's the perfect storm for advice. The advice profession is going through rapid change, and it's benefiting younger advisors who are more qualified. So we took the step out in April 2023.
Oh, it's nearly your birthday.
Yeah. So we started. We've had rapid growth all the way through, and it just shows like all of our clients are either self-funded retirees or high-income earning accumulators. So for us, it's been nice to have both sides of the spectrum, and that's the advice that we've come from is that high net worth.
Yeah, and you guys have grown quite a bit. You've got nice little fancy digs in Newstead. I like it. It's good selection of food downstairs. But I guess having your own office, like it's a nice, gentle slope to us, going from working in a small little office, now you're in a bigger environment. You've got other professionals around you, in that area. And, it's great watching you guys grow. And I know you're really good at your job. So I've been through the process, right? Or still going through the process. So it's really, really good. But, I talk to you, or, you come to me for a few clients around SMSF and lending. And, the one, when it comes from someone like yourself, I know that they've got the advice, but 9 times out of 10, they don't.
Correct.
And I just want to touch base. So this is the very, very first thing. Now, I have got no problems if you're wanting to purchase a property in SMSF.
Mm-hmm.
For me, I just want to know that you've actually got the right advice to make sure that you're doing it. Now, what I want to throw to you is you want to borrow an SMSF, and I think you don't have an objection to that either, correct?
Correct, yeah. I'm a big fan.
Great, but what are some of the things people should consider before jumping into an investment like an SMSF?
Yeah, correct. So what our job is there is a lot of strategy around it, but when it comes to self-managed super funds, is it actually relevant for you? Do you have enough in super? There's some clients that have less in super but are contributing a lot, so they might be small business owners. But really, it's about the sustainability of it. We, with self-managed super funds, there's an accounting and audit requirement every year. It costs more to set up. So it's a big hurdle to jump through. You don't want it to look great for the first year and then, be unsustainable and having to throw in additional money every single year after that. We try and find that, we've got to outlay the different options. Sometimes it's not suitable for everyone, and it's great to take a step back and just go, hey, I know you wanted a self-managed super fund. Let's take a step back. I think it'd be better that you purchase that property individually or through a trust, because you don't have what it takes at the moment to get a super fund. And it is about just looking at all of their options. But for all of our small business clients, when, you're a mortgage broker or you've got a service-based business, you've got tradies that need tilt panel sheds, those are the ones that it really stacks up with. It can be a really good aspect for them to step into, and we try and model that out for 20 years, adding in all of the costs, being really conservative, just make sure it's actually suitable.
And I think that's the biggest, I just want to borrow my SMSF. I don't think people realize what actually goes into doing. You can't just click your fingers and it happens. There's so much legislation behind it as well. The lending side of it's actually not that hard, right? It's more getting to the point where you're able to make an offer. So, you've got your retail super fund. You need to set up the SMSF trust. And if you are thinking about borrowing in an SMSF trust, I strongly urge you to get the advice on whether you set the trustee up as individuals or a corporation. The lenders will only lend usually to corporation, like a corporate trustee. And from what I've been told by account, is that's better for the asset protection side of it, isn't it?
It's better for asset protection. It's better for estate planning. And lenders, it's just so much easier. When you borrow with the corporate trustee, you can have change of ownership within the
someone dies and something like that.
Yeah, correct.
Yeah,
so, if your partner dies, you don't need to go through that whole change of name process, change of ownership. It's still the corporate trustee that owns that property. So it makes it a lot easier from, the sustainability and ongoing servicing point of view, cleaner for estate planning. But it is really around, getting that right advice. It's going to cost you a little bit more to set up because we've got a, company set up. You've got ongoing ASIC renewals, but with self-managed super funds, they do get a special discount with their ASIC renewals. So you do pay more upfront, but it's only about $63 a year to renew.
As opposed to 300 and something.
Yeah. So way cheaper.
Yeah, let's get it. Yeah, because that's the cost. But also then on top of that, in order to buy a property, you don't buy it in the self-managed super fund. Well, you do. You take the loan out in the self-managed super fund, but the property is actually held in a bare trust. Correct, because the the type of lending that we're doing is limited recourse lending. So it's held in a bare trust. So therefore, you need to also set up another company with a trust that holds the actual asset and the loans under the SMSF. So again, you've got to get the right advice and you've got to get that set up. Now, it's not a quick ease. The trust setup's really quick. Sometimes when I see people trying to buy property, they don't even have the SMSF set up. That's not set up. The bare trust is set up. You can't actually sign the bare trust too. But there's certain requirements you've got to meet. But the money, this is the thing, getting it from the retail super fund into your cash management account, it's not an overnight transaction, is it?
Correct. So when you set up a self-managed super fund, you essentially have to have that bank account ready to go in the name of the super fund. And the ATO requires that when you're rolling over funds that they actually get transferred through the clearinghouse. So they essentially pass through the ATO's checks and balances. So when people think, well, it's just I'm just rolling over from X super fund into my self-managed super fund, how long could it take? Your industry super funds and your retail super funds, they've got a process to follow when they roll those funds over. They can't just write a check or do a bank transfer.
Bank transfer.
And
an OSCO payment.
Yeah. So from that point of view, they've got compliance that they need to check. They need to actually make sure that your super fund's compliant. If it's non-compliant, the ATO will essentially put a penalty tax of 47% on that fund.
Yeah, there's so many rules. That's why you need the team, right? And I do talk about this a lot. You don't do that. You never. I just don't feel if you don't have a good team, right? If you're trying to expand your portfolio, you need certain key players in your team. One of them, obviously, you've got to have a good accountant for your tax. You got to have your good finance broker for your actual debt structure and strategy. To find properties, I feel buyers agents are your best bet.
100%, yeah.
But I think the one that people miss out, like they don't actually have, is a financial planner. And the reason I think that's important is because they're going to plan it out over 10, 15, 20 years. Now, that may seem like a lot. It's you'll agree, like you're trying to forecast over 10, 15, 20, 30 years. No one can see that far ahead.
It's also linear in nature.
Yeah.
But from our point of view, we look at upcoming legislation. We look at how superannuation will change over time. So it's a lot of people think, I'm going to get advice. I need to just go do it. But it's also a bit of a ongoing relationship as well. So with our clients, we regularly change things with either their investments, their view on things, how much we're going to focus on super versus trusts and personal assets. So with that, it really comes down to, regulation and legislation is a changing beast. We've got, potential that a $3 million super cap will come in. Unlikely at this stage, but, it's things like that where when they do come in, it's how do we change course? How do we adjust and maneuver around it so we're not waiting to, that implementation day and then everything goes wrong. We want to make sure that, when buying a property, that all your ducks in a row, your mortgage brokers, got the funds ready essentially for settlement. So, our job is to make sure that the money's there, that everything's compliant. We work with the mortgage broker, we work with the conveyancer, and we work with the accountant just to make sure that everything's set up right. And that's a big job for some people. Like we've had people try and do it themselves. And
I don't recommend doing it yourself.
And let's just say the conveyancers haven't been happy. The mortgage brokers haven't been happy. And that's just because the funds aren't there for settlement.
Well, luckily, one of my really, really close friends, she did a purchase through a self-managed super fund. All set up correctly. The real estate agent didn't fill out the contract correctly. And luckily, there's one thing, and being in my experience, I said, do not sign that contract till you've got the solicitor review it. Yes, it'll cost you $350 to $500, but if you sign that and it's the wrong contract, like it's the wrong name, you've executed the contract basically, and you potentially could be up for double duty, and that'll actually cost you more than $350 to $500.
And it could actually prevent them from buying that property altogether.
Correct.
Don't have funds anymore. can't execute it. So
Yeah, exactly. And it's just about that little piece of getting the people that are experienced to understand, slow you down. Yeah, we're all keen to get a property. Well, it's not going anywhere. You still have a due diligence period. Like you still that's what the finance period's for, right? The finance period doesn't start till you actually sign the contract and the other party sign the contract and there's the date on the contract. You have every right to review. It's actually your obligation. Like you've got an obligation to review that. But if you choose not to, it's your fault. That's why we get solicitors, like you get conveyancers. So luckily she didn't. There was 6 errors on that contract. I found 3 just on the first page.
I'll send you my invoice.
Yeah. No, well, that's part of no, that's a good broker. You're still checking because I still need to make sure that when we input the application, it's the right information. My team is passing on the right information to Michelle, Sarah, and Taylor, who actually put these applications into the system. Right? I don't want them coming back to me and going, "Oh, well, why doesn't this match and this match?" That's just not done my job.
And I think that's just the importance around getting a good mortgage broker. You know, I think there's a lot of people out there that say that they can do self-managed fund lending, and the proof is in the pudding sometimes. We have had some mortgage brokers absolutely make a disgusting mess of lending. And I feel like if you've got someone that's good, that actually understands self-managed funds, how the process is meant to work, that you'll breeze through that whole process because it comes back to having that right team, doesn't it?
Yep, 100%. And I think I've seen so many cases. I know I've seen so many cases. And another client went to 2 mortgage brokers and they couldn't do it. They didn't understand it. And literally only one thing needed to change. We got it approved in 2 weeks. Still made their time. They had a 28-day due diligence. Buying a rooming house in their super fund can only go to one lender one lender that'll do it to 80%. But I was in Melbourne. I just picked up the phone and went, tell me more. Question. Yep, cool. Tim, can you just get the stuff from this client? This is what we need. Monday morning, strategy done, handed over, submitted Tuesday, evaluation ordered Tuesday, approved by Friday the week after.
It's a peace of mind factor, isn't it?
Well, but do you know what the one thing they didn't check was the contract? They were saying this contract's invalid because what they did put on the contract was chattels. Like, no, you can't do that because it's a single acquirable asset. You can't acquire the house and the. I said, well, you speak to the lawyers. Hey, can we remove that? Is there something we can remove? Can we have something on the other side of it that we can look at? I'll leave that to you. That's not my sin. But literally, these 2 words, they just need to go, and then we can just proceed. And I told them that right at the front. So when it got to the end, they're like, the lender was can't use this contract. No, actually, here's the revised contract. Bang, done, perfect. Approved. No, I'm already on that. So that was stoked. It wasn't a hard deal. It was just, you just got to read it. What's wrong? What were the problems you're facing? But I'm doing a lot of SMSF at the moment. And it's this ripper. Like, I love it as a self-employed client. Like, you're a business that you're just talking about people buying tilt sheds. I got a client that's buying 2 clients. One runs the business in the property that they're in at the moment. They're paying rent. They're buying that property. Tick. They're buying it in their self-managed super fund. Another client he's an electrician, needs his new shed, same thing. It's the only time you can actually buy in your SMSF and use it because you can't buy resi property in your SMSF live in it. It's not for owner occupied. But man, if like you were saying, if you're self-employed and you've got a long-term plan, you've seen a financial plan. It makes sense.
If you're a business owner and you're looking to acquire an office or a shed, and you're young, it does stack up. Your business is able to rent that property off your super fund. It's also a great sense of security. You're paying 15% tax inside super. We get to that point where you're retired. We turn you up to $2 million each. So, husband and wife, $4 million, completely tax free. What could be better for retirement planning than being able to, pay a really good rent to yourself have it completely owned by you, but have it, essentially fund that retirement plan, get the most out of superannuation, because it is a really good tax break for a lot of people. And, if you can set it up right from the start and get that good advice, it's going to pay tenfold.
100%. And I think this is where, in the first question I asked all of them, did you get advice? And you need to link me up with your accountant and financial planner, because I've got to ask them questions, because they've got to give me all the documents and all the correct documents. But mate, like, how good is that though? Even if some of them don't buy the if you're PAYG,
correct, yeah,
they're buying a lot of. A couple of my clients are doing SMSF, purchasing in their SMSF for rooming house.
Rooming house is a great one from our point of view. You're buying generally in really good suburbs, so you've got a 5 bed rooming house. The yields on them are very high. They sit in the vicinity of that 6 to 10% quite comfortably. So you've got essentially commercial yields with residential land growth.
Yep.
So from the planning point of view, we look at the what ifs. And with a lot of the rooming houses that we've looked at, they can be converted back to, a large double-story house. They already have all the infrastructure there, so it's a small renovation if down the track you wanted to convert it back to a traditional house. But for the rooming accommodation, they do suit, some of your higher income earners that are looking to acquire, a leveraged asset. So we look at our younger clients having that ability, outside of super, we're leveraging their positions. We do that in a nice diversified fashion, but, essentially in that part, it's if you're, on 200-300 grand plus, you've already got a lot going into super. You're generally going to have a pretty good super balance. It's, the biggest drawback's going to be the purchasing costs. We've got stamps, we've got setup costs of the super fund, but after that, if you are getting that 6 to 10% yield, it's pretty self-servicing to that point. And that's what we look at. It's a sustainable way for it to pay for itself throughout your working career while we build up other assets on the side.
Yep.
But they turn out to be really great from a modelling point of view.
Yeah, and I think where, it's tougher to get you can't build, you can't construct in your self-managed super fund. There are people out there that'll do a one-part contract, so they'll go do the build, costs a little bit more. But if they've already found, if there's an existing rooming house, let's talk rooming house, like what we're doing, it's already getting the rent, you already know it's coming in. Yeah, okay, you're going to pay stamp duty on the purchase price. But when we get that valuation done, it's done as a commercial valuation. So they're using the cap rates on the rental, which is great, awesome, gets it to that value. But in that valuation, there's also the alternate use valuation. So like you were just saying, should it be switched back to a normal 5-bedroom house, 5-bedroom, 5 ensuite house with kitchen and laundry? What you could potentially get.
Your
at that point.
McMansion's still going to have a fairly good valuation.
Yeah, I think there's maybe 100 to 150,000, depending on the area and the quality of finish. Very, very little. There's very little difference between the two because of the area and the type of property. Now, a lot of these properties will, depending on what they've done, I've seen some really good ones. They're great for young professionals to even rent out. Now, we've got a housing crisis, right?
The rooming accommodations really suit our current environment.
Yep.
I think, when you've still got 50 to 100 people showing up for rental property inspections, some people don't want to be paying $1,000 a week. You've got a very high standard finish on these rooming houses. You've got essentially a studio apartment. So anyone that's already living in a studio apartment is going to get the same sort of vibes. They usually come with all the bells and whistles anyway.
Yep.
6 kilowatts of solar. You're going to get
fully furnished. It's got the security systems. The locks are all on the new ones. They're all digital locks.
Yeah, and from that point of view, you go, even if in your standard commercial properties, your biggest risk is that that's going to stay untenanted for 3-6 months, and that's going to cost. So that, that risk is obviously eliminated when you're the business owner. For a rooming accommodation, you can have one sitting vacant for a week or two. It's not really going to matter. You're still getting 80% of your rent through.
Yep.
So it's really appealing from our side of things is you don't need to have it fully tenanted to be paying the bills. It's going to fund itself, especially when we start getting to that, closer to 10% yields. Your mortgage rates sit at what, 7?
7.4. Well, last one I did was 7.49.
Yeah.
In the SMSF.
And
P&I 25. 30 years. 359 months. P&I. Yep.
So it's relatively it's paying for itself all the way through. So if you do have a period where you need a tenant, it's not going to be an issue. There's also a shortage of properties, so it's not only people going to rent them out. Room accommodation also suits businesses that have staff that are flying around the country. A lot of these rooming accommodation ones in Brisbane are in really good suburbs. So it suits, big companies that just need a room for a staff member. They don't necessarily want to always send them to hotels.
It costs more for the hotel. It costs you $400 for a night, or you could have $420 per week, and it's just there. It doesn't even need to be, you just have them in there. It's more cost effective that way.
Yeah.
And some of those leases are done for companies. I've seen them because I get to see all the leases. But I think the other advantage of that is as you're, I'll give you a very good example of one of my clients who purchased under a trust, developed the property, knocked the house down, built a rooming house. They built it and then they sold it to their SMSF. Not at arm's length, but we got all the advice to make sure that happened. The valuation was done correctly. So it was all done. We all ticked all the boxes. The quality of that product, and big shout out to Paul from Brisbane Rooming Houses, mate, that was a phenomenal. It was a 43 squares per room, I think. They were huge. TVs, lounge, bed, everything.
Just ready to go.
Ready to go, right? But you looked at the location; it's on Sandgate Road. Now, if you're on the Brisbane north side of Brisbane, Sandgate Road is one of the busiest roads. But because of the rental yield, each of those rooms were rented out within a week of going on the market. So they rented out. They advertised the first 2 rooms, got them rented, then advertised the next 3 rooms, just because we knew that was going to be there's scarcity. But they just went out. They just went. I got that thing valued. I think they purchased it for maybe, let's say late 800s. So let's all up. You're in at 930, right, including their cost. Built for 650 or something odd thousand. So what? That's 1.4. I think their total cost ended up being about 1.3. We got that thing valued at 1.6.
Yeah, perfect. And
that's the highest one that I've ever had valued.
And I feel like that works so well. It's rooming accommodation, commercial properties. The only one that sort of, comes up with a bit of hesitation sometimes is your residential. It does suit some people because you've got the capital growth, but I feel that some people come in expecting that they can leverage off their existing self-managed super fund property, and that's a no-go. No,
that's probably another one of the biggest restrictions is you can't recycle equity. It's not it's limited recourse lending for a reason, right? And it's to protect your self-managed super fund and protect the asset. It's not, if it's outside of super, yeah, we can do that strategy. Inside of super, you either sell it, pay the capital gains, and then go again if you're under 60. But it's there for the long term.
It's one of the things that we go through a big education process with our clients, and we try and make sure that they understand the rules and responsibilities as a trustee of their super fund. But also on the flip side, it's trying to break down some of the myths that people have. They're on TikTok learning from influencers. We try and make sure that the stuff that they're wanting to implement is actually doable. But a lot of people come in and they go, I'm going to buy my first property, and then in 1 or 2 years' time, I'm going to use the equity, and you have to stop them right there and just go, look, this isn't going to work. So we have to make sure that that property that you're buying is actually going to be a good property. You know, it's going to have good cash flow. It's not going to be a money pit. So it makes people take a step back and just look at that property decision. We're big advocates for, you know, building wealth through property and using leverage, especially for younger clients. But it, you know, at the end of the day, it's still got to stack up for you. And that's just breaking down some of those misconceptions. But, you know, for the clients that are ready and, you know, it makes sense for them, we are 110% there to support them in their property journey.
I think, again, you know, you circle that back to what you were saying, leveraging and things. You really need the right team behind you. And I said this in the last podcast and many podcasts before. You don't want a team of yes people. You want a team that will challenge you. That's the only way you grow. Like, you can't just, it's because you think it's the right thing. Great. Yeah, but where'd you get the information? How have you done your research? Oh, my mate told me.
You've got to have someone that's going to call you bullshit sometimes.
Yeah. I'm like, far out. Like, you know, what does your mate do? Oh, he does nothing to do with what you're trying to do.
Yeah.
Right. Is your mate part of your trusted advisor network? Do they work in finance, accounting, financial planning, insurance, property management, things like that, right? So it is about getting the right team and not a team of yes people. And I do feel there are a lot of yes people out there just to get the deal.
Correct, yeah.
I know you and I aren't.
We've had it before where people come in, they go, I want a self-managed super fund, and we, you know, have to go back and question them. Why do you want one? I want growth. You know, you might have a $200,000 account balance and you suddenly want to buy, you know, $500,000 plus property. You're not making contributions to super. You know, from our point of view, it doesn't make sense. We look at alternative options, but, you know, if you're a business owner or a high income earner, and you're putting, you know, your full concessional cap in at 30,000, we've got some that use what's called a carry forward contribution. So, especially for business owners that haven't been making contributions for the past few years. So it's essentially if their super balance is under 500,000, they can go onto their ATO portal through MyGov and actually check what the unused concessional contributions are. And as long as their super balance is under 500,000, they can go back 5 previous years. So we've had some clients where they weren't earning a great deal in, you know, the previous 5 years. It's only been the last couple that they've been earning, you know, $400,000 or $500,000. And through, you know, through their business structure. So they're not personally taking $400,000 to $500,000. But, you know, from their point of view, it's a great tax lever. We can inject $50,000 a year into super. They can go and, you know, buy that commercial property, or they can go and buy that rooming accommodation. The same thing for doctors. You know, we see doctors come through. They go through uni. You know, they're an anaesthetist. They start off in you know, a hospital on, you know, a couple $100,000, but every time you see them, it's like their wage, you know, it goes up by either $100,000 or it doubles. So, you know, for them, it's a great tax lever. We can essentially get, you know, for some clients, a 15% net benefit. So we put $1,000 in, we get 30% generally back in our tax returns, and then, you know, the super fund pays 15% tax, with the only exception being when you, you know, go over $250,000 threshold and you get
$293.
Yeah, and that for high income earners, that comes as a shock, getting a little notice from the government. But you know, essentially, you're still putting money in at a 30% tax rate. Your personal tax rate is 45%. So, worst case scenario, you're still getting that 15% net benefit.
Yeah, and I think one of the things when you are a high income earner, one of the things the SMSF funders will ask you is, where are you paying the Div 293 tax? Is it going to be inside or outside of the super? Because that actually affects servicing. So you've got to make sure that, you know, if it's outside of super, they don't care. If it's inside of super, we just have to adjust. We just get a letter from the accountant to cover that off. And usually it'll be outside. Usually they pay it outside of super.
Yeah.
I've never seen one pay it inside of super.
We tell our clients, like, the whole purpose is that we're paying, like, we're trying to inject money into that concessionally taxed environment. We don't want to be then, taking money back out to pay for these bills. So we sort of factor those in personally and pay for them personally.
The cost of making money, eh? Everything has a cost. But look, I mean, that's been really good. I think that's a good indication. I think the key thing we've touched on is we can use SMSF as a tool to diversify your investments too. And if you are a small business or looking to expand and need a property, that's one of the ways we can, really plan out the future. Or if you're not, there's other types of property you can do to plan out that future, get high yield and capital growth. Again, you've got to see someone like yourself to actually, is that right for you? Mate, before we finish up, and I ask this of every specialist in their field, what are going to be your top 3 tips to set yourself up going forward in 2026?
It's going to be a boring one to start, but it is getting that team right. If you don't seek out the advice and you're just going off, some articles off Google or ChatGPT, there's going to be things that you miss. You need someone that specializes in your field of advice. And it's the same with accounting. It's the same with mortgage broking. Like, not everyone specializes in every field. So just getting your team right. And really, probably number 2 is with everything in life. So for business owners, PAYG, we want to build up assets in different points. So step number 2 is, we buy a property in super. We don't want to just have a property in super. We want to build up assets alongside that. And that's really because we can't sell a bedroom. We want to, get to retirement. We don't want to be forced to sell the property. We want to keep, having it chug along. So just be mindful that buying the property is step 1. Step 2 is then how do we build, our personal assets out? How do we build our self-managed super fund assets out? And that's our job. We're there to really support our clients on their next moves. We look at all the cash flows within the super fund and outside, and it's really about making those moves. And I think, number 3 is just uplifting financial education. So, whether it's through a podcast, through, reading books or, going onto professionals' websites, I feel like the biggest step that people can really do to help themselves is to uplift their financial education and, follow those professionals through and, seek advice out. If it's not right time for you, a lot of professionals don't mind. They'll put you on a mailing list. They'll have those initial chats with you. And, as long as you're going to a professional, they're going to say, it's not the right time. We'll see you in 6 months, 12 months, 2 years. But I think, if you can at least take that step into uplifting your financial education, you're going to be a hell of a lot further than everyone else.
Well, great tips. I think, that the theme is get the team behind you. That's the last 6-7 podcasts, that's what everyone said.
Term it like the squad.
The squad. No, that's Jono's. That's Jono's buyer's agency, the buyer squad. I can't frame. No. You just do a good team. I can't stress that enough. But mate, really appreciate you coming on board. Again, I'll say it again. I said it at the beginning. This is very general advice. If you want specific advice, come and see Troy or myself, depending on what you want to talk about, mate. But how do we find you? How does someone find you?
If anyone wants to get in touch, they can head to our website. They can go on our socials. So all of our tags are Willow Wealth Partners. We are fortunate enough to have quite a long tag. And also, if you go to our website, we've got willowwealthpartners.com.au. They can book in for a 30-minute free consult, just see if advice is right for them. But we offer that to all referrals coming in and all of your podcast members.
Awesome. So anyone that did get something from this, very, very easy to share it. Just share it. click the share button. Share it to your friends, family. Also, while you're doing that, click the follow button. Doesn't cost you anything. You will help support small business in Australia. Like I said, that's the only thing I ask for people is just follow along, give Willow Wealth Partners a follow. It doesn't cost you anything. My Instagram handle at Dion Finance Specialist. Give us a follow. All this stuff will be there in short form, long form. If you want to get in touch with me, my link's on there. Follow me on LinkedIn. Dion Fernandez, can't miss it. And if you want to know more about Emerge Finance and the greater team, www.emergefinance.com.au. Again, if you like what you hear, keep following us. Don't forget to review the podcast as well on Apple. Thanks again for coming, Troy.
And thanks for the invite.
No worries. See everyone on the next episode.